Hi everyone. Today we're gonna talking about three major factors that affect pricing decision, how companies make long-term pricing decision, target costing and cost-plus approach, concepts of cost insurance and locked-in cost, and life cycle budgeting and costing, and effects of legal restriction on pricing. Most businesses carefully analyze their input cost and product price. As you know, customers will go to competitors if the price is too high. If the price is too low, the company cannot cover the cost of creating the product. Corporation must also understand how its clients will react to different price tactics. Managers at many companies such as Amazon and Walmart are strategic in their pricing decision. Now we're going to describe how managers evaluate demand at different price and manage customers and cost across the value chain and over a product life cycle to achieve profitability. How managers price product or service ultimately depends on demand and supply. Three influences on demand and supply are customers, competitors, and costs. Customers have an impact on price by increasing the demand for a product or service. Managers constantly look at pricing decisions through the eyes of their customers and then control costs to maximize profits. When competitors exist, managers attempt to learn about their technologies, plant capacities, and operating strategies in order to estimate competitors' cost valuable information when setting price because it helps managers understand how low competitors are willing to go on price without incurring a loss. Cost influence price because they affect supply. Companies supply goods as long as the revenue from new sales exceeds the cost of production. Managers who understand the cost of manufacturing items set pricing that is appealing to customers while increasing operational income.
Before moving on to the long-term pricing decision, we can briefly talk about what the short-term pricing decision is. Short-term pricing decisions have a time span of less than a year, and there is no long-term effect. At this point, pricing a one-time special order and adjusting the product mix and output volume in a competitive market can be shown as an example of short-term pricing. When we come to long-term pricing, we see that it is designed to establish long-term relationships with customers based on stable and predictable prices. At this point, when we look at the tendency of the managers usually prefer stable pricing because they think that stable pricing reduces the need for constant monitoring and improves planning while establishing long-term buyer and seller relationships. If we give an example of stable pricing, we can say that McDonald's makes stable pricing with its dollar menu consisting of fast food products. The price of Nespresso, which was US dollar 0.70 per capsule of coffee, was also among the prices that remained stable for a long time. But applying a stable price should be in a system where managers calculate the cost that will be incurred in the long term to supply products to customers, including all the costs that may be encountered in the future in order to achieve the long-term goal. We know that the indirect costs of given cost object are costs that are related to that cost object but cannot be easily tracked. These costs usually make up a percentage of the total cost allocated to the products. At this point, we can give an example of Astel competitors' cost allocation issues. Astel manufactures two products, a high-end computer named West Point and a laptop with an Intel Core i9 chip named ProValue. When we look at the 6 business functions in Astel's value chain, we can call them research and development, product design and processing, production, marketing, distribution and customer service, respectively. Astel managers separate indirect costs from all 6 business functions when making pricing decisions for West Point and ProValue. Because in the long run, selling a product is only valuable if the price that customers are willing to pay for the product exceeds all the costs incurred to produce and sell it while getting a reasonable return on the invested capital. Furthermore, to increase profits, managers focus on high-margin products. For this reason, the pay based on product profitability in addition to their salary, specifically to motivate salespeople to sell products that not only increase revenues but also business income in general. Cost allocation have an impact on managers' choices in cost management. For instance, us sales managers are prompted to build Pro value with fewer components to lower these expenses after recognizing all costs associated with ordering and purchasing. When we look at the table, we see the various purposes of cost allocation and the examples given to them. Deciding the selling price for a product or service serves the purpose of providing information for an economic decision. However, the purpose of costing inventories for reporting to outside parties is to measure their income and assets. We can list the various purposes and tasks listed in the table as follows. We see that our primary purpose is to provide information for economic decisions. Example of this would be deciding on the selling price of a product or service, deciding whether to add a new product feature or not. Our second goal is to motivate managers and other employees. Examples of this would be to encourage the design of products that are simpler to manufacture or less costly to service, and to encourage sales representatives to emphasize products or services with high margins. Our third goal is to realize the cost or calculate the repayment amounts. Examples of this would be costing products a fair price as often required by law and government contracts, calculating reimbursement for a consulting firm based on a percentage of the cost savings resulting from implementing its recommendations. Our fourth and final goal is to measure income and assets. Our examples would be costing inventories for reporting to external parties and costing inventories for reporting to tax authorities. Here we see the two approaches for pricing decisions. Let's look first at the market-based approach and then we will review the cost-based approach. The market-based approach to pricing starts by asking, given what our customers want and how our competitors will react to what we do, what price should we charge? Managers manage expenses based on this price in order to achieve a desired return on investment. The cost-based approach to pricing starts by asking, given what it costs us to make this product, what price should we charge that will recoup our costs and achieve a target return on investment? Businesses that operate in highly competitive markets, such as those for commodities like steel, oil, and natural gas, must adopt a market-based approach. Finally, if we look at the corporate impact of these approaches, the goods or services produced by one company can be easily replaced by goods or services offered by other businesses. So, companies operating in these markets are obligated to accept the market prices.
There are three reasons should be applied before setting prices in an approach. Managers have to understand customers and rivals for these three reasons below. Prices are consistently constrained by lower cost competitors. Because products last for a shorter period of time, businesses have less time and opportunity to correct pricing errors, loss of market share, and loss of profitability. Due to easy access to prices and other information online, customers are better informed and demand high-quality goods at competitive costs. First of all, I would like to talk about what the target pricing is. Target pricing involves identifying a competitive price in the market and adding a firm's typical profit margin in order to reach the highest cost that a new product can have. Then a design team works to can produce a product with the necessary features while staying within budgetary restrictions. The project is abandoned if the team is unable to finish the item within the budgetary restrictions. By using this strategy, a company can ensure that each product in its range will generate a respectable profit without having to deal with any low profitability items. However, if the typical profit margin is set too high, it could be difficult to create a large number of items. For example, if a company sells toys and the average market price is $10 per toy, the company may also set the selling price at $10. If they decide to make 10% profit on each sale, that company must earn $10 per toy. To achieve its goal, the company must manufacture the toy at a cost of $90 or less. If the production cost is over $90, they won't be able to make the profit they want, and they will likely not continue selling toys. There are four steps to develop target prices and target costs. Firstly, a product that meets the needs of prospective customers should be created, and then you should decide on a price range. After, calculate the goal cost per unit by deducting the target price from the target operating income per unit. And finally, value engineering should be used to hit the goal cost. If we assess the previous example again, the company has to achieve target operational income of 10% per unit by selling 150,000 units in order to reach the desired return on capital. The target cost of $90 per unit is $45 less than the average unit cost of $135. The company has to cut expenses along the entire value chain to meet the target cost. Target costs include both variable feature costs and fixed feature costs in the short run, because prices and revenues must exceed its overheads in the long run for a company to survive. However, managers consider only short-term costs when deciding on short-term pricing or one-off special orders.
Hello everyone. I will talk about value engineering, cost incurrence and locked-in cost. Value engineering is a discipline used to develop a design and manufacturing process for a product, service or process to meet customer needs at optimum cost. This process includes steps such as understanding the customer's needs, optimizing the design of the product or service, planning the production process, controlling the cost, and increasing customer satisfaction. Value engineering is used in product or service design and manufacturing process to reduce the error rate, improve the quality of the product, increase customer satisfaction, and reduce the cost of the final product or service. This discipline includes experts from various fields such as engineering, business, and finance. It is usually applied by a team in complex projects. To implement value engineering, managers separate value-added activities and costs from non-value-added activities and costs. A value-added cost is a cost that, if eliminated, will reduce the value or benefit that customers experience when using the product or service. For example, value-added costs could be reliability, adding a new function to the product, fast customer service, or certain product features and attributes required by customers. A non-value added cost is a cost that, if eliminated, will not reduce the value or benefit customers derive from using the product or service. Examples of non-value added costs include defective product costs, machine breakdown, adding unnecessary features to the product can be displayed. Companies try to minimize non-value added costs as they do not benefit customers. Cost incurrence refers to the process of incurring costs, expenses, or liabilities for goods or services that have been used, consumed, or acquired by a business. It is the act of spending money or incurring expenses as part of the normal course of business operations. Locked-in cost is a type of cost that is fixed or committed and cannot be changed or easily modified in the short term. It is a cost that a company has already incurred or committed to and cannot be avoided or reduced, even if circumstances change. Examples of locked-in costs include long-term contracts with suppliers, leases, and salaries for employees. These costs are often difficult to change, and a company may be required to continue paying them regardless of changes in market conditions or other unforeseen events. The best opportunity to manage costs that are difficult to change later is the period before costs are fixed. To summarize briefly, topics we discussed were to compare the value-added and non-value-added cost with customer requirements, how the costs are fixed before they occur, and to reduce costs while responding to the demands and needs of the customers and recreating the products. Now my friend Sıla will continue.
Hello, I am Sıla. While value engineering and target costing can have several benefits, they can have undesirable effects if not managed properly. These effects can be explained as 1. Employees may feel frustrated if they do not meet their goals. This creates low morale. Low morale can affect their productivity and quality of work. 2. The cross-functional team may add too many features just to accommodate the different wishes of team members. This can lead to an over-designed product that is expensive to manufacture and difficult to market. 3. A product may be in development for a long time as the team repeatedly evaluates alternative designs. In this process, market demands may change or competitors may launch similar products. This creates a problem. 4. Organizational conflicts may develop as the burden of cutting costs fall unequally on different business functions in the company's value chain, because each department will try to protect its own interests. The organization needs to be aware of these undesirable effects and take steps to mitigate them. These steps include 1. Encourage employee participation and celebrate small improvements toward achieving the target costs. Celebration encourage collaboration, as employee involvement is important in setting target costs. 2. Focus on the customer. Determining what the customer wants from the product or service. 3. Pay attention to schedules. Time is important. Realistic timelines are required for new products. Not having the right timetable can lead to losses. 4. Set cost-cutting targets for all value chain functions to encourage a culture of teamwork and cooperation. It is helpful to set targets for all value chain functions such as design, manufacturing, and marketing.
Cost-plus pricing is a pricing strategy used by businesses where the selling price of a product or service is determined by adding a markup percentage to the cost of producing or delivering that product or service. In other words, the selling price is calculated by adding predetermined percentage markup to the total cost incurred in producing or providing the product or service. Where to use cost-plus pricing? Cost-plus pricing is commonly used in industries where production costs are relatively stable and predictable, and where businesses want to ensure they cover their costs and generate a desired level of profit. However, one limitation of cost-plus pricing is that it doesn't take into account market demand or competitive pricing, and may not necessarily reflect the optimal price that customers are willing to pay. Therefore, it is important for business to consider various factors, including market conditions, customers' preferences, and competition when setting their pricing strategy. One example of cost-plus pricing can be given as follows. Cost-plus pricing production is widely used in manufacturing industries where production costs such as raw materials, labor, and overheads can be accurately calculated. Manufacturers can add predetermined profit margin percentage to their total production cost to determine the selling price of their products. What is the main advantage of cost-plus pricing? The main advantage of cost-plus pricing is that it is simple and straightforward. This pricing strategy is easy to understand and implement.
since it involves adding a markup or fixed percentage to the cost of the product or service to arrive at the sale price. This allows business to quickly and easily price their product and services without having to worry about complex calculations. What is the main problem with cost-plus pricing? The main problem with cost-plus pricing is that it doesn't take into account demand or competition, meaning that businesses may be charging too much for their product and services. This can lead to missed sale opportunities and lower profitability. Additionally, cost-plus pricing doesn't incentivize business to reduce costs, leading to higher prices for consumers. And how can determine cost-plus pricing? Mathematically, the formula for cost-plus pricing is cost plus price equal total direct cost plus allocated indirect cost plus desired profit margin. Profit margin based on the targeted rate of return on investment. The target can be calculated as annual operating income divided by invested capital. Uh, and it is difficult to calculate a specific amount of capital invested in a product because requires difficult and sometimes arbitrary allocates of investments in the equipment and building to individual products. These variable costs, production costs, and full cost. They use the entire cost of the product for manager cost-based pricing decision. As a result, they often include variable costs and costs that are fixed in the short run. When the calculating cost per unit, they do this for several reasons. The first is that all costs of the product are fully covered. If a company is to stay business for the long term, the target price of a product must exceed the full cost of the product. Second is price stability. Using the full cost of the product as the basis for pricing decisions, which it adds the ability and charm of the lower prices. And finally, simplicity. The full cost formula for pricing does require the management account to perform the detailed analysis and cost before pattern to break down product cost into variables and fixed components. The selling prices computed under cost-plus pricing are prospective prices. The target pricing approach reduces the need to commute between potential customers. Target pricing, unlike cost-plus pricing, it first determines product features and target price and identify customer preferences and possible competitor responses, and then target cost.
Hello, this is Enes. Now after we have explained the cost plus pricing method, I'm gonna show an example to demonstrate how this method is applied by managers in the companies to price product. The example is this. Suppose Astel uses a 12% markup on the full unit cost of Pro Value 2 to compute the selling price. Now we need to compute the selling price using a markup component which is 12%. Let's see how we're going to do this. First, we need the cost base, which is the full unit cost of Pro Value 2, which is a product in the company. Then we multiply this by the markup component, which is 12%. And we add this markup component to the cost base to get the prospective selling price. Now another way to compute this is to add 1 to the markup component and then multiplying it by the cost base, and then we can get the same result that we got earlier. But how do managers determine the markup component, the 12% in our case? Let's see. One way to choose the markup percentage is to choose the markup based on a target rate of return on investment, which is the target annual operating income divided by the invested capital, the amount of capital invested in the company. Now this target rate of return represents the future value or profit that an investor expects from their investment in the company. So the invested capital in our case is the total asset of the company, and the target rate of return on investment is 15%. Then we can calculate the target annual operating income by multiplying the target rate of return on investment by the total assets, and then we get the target annual operating income. We then divide the target annual operating income by the number of units that the company is expecting to produce, and we get the profit or the operating profit per unit, the amount of profit that we are gonna get per unit. Now this is the same result that we got when we multiplied 12% by the cost of the product, the full cost of the product. But there is a very important issue here, is not to confuse the target rate of return with the markup percentage. The target rate of return is how much operating profit the investors expect from the company to gain on the assets it invested. But the markup percentage is the amount of cost from the cost, from the amount of profit from the cost. So here we see the difference. The 15% target rate of return on investment is the target annual operating income as percentage of the investment, but the 12% markup expresses operating income per unit as a percentage of the full product cost per unit. And that is all for this example.
We have seen so far that cost is a major factor in setting price. We now explore how legal, political, and economic considerations influence firms' ability to set price in relation to their cost of producing and delivering products and services. Predatory pricing occurs when a firm sells a good or service at a price below cost with the intention of forcing rival firms out of business. Predatory pricing could be a method to deal with new firms who enter an industry. If a monopoly is enjoying supernormal profits, it's likely to attract new firms into the industry, who will reduce the incumbent's profitability. But in response, the incumbent monopoly could cut price and make a temporary loss. This low price and operating at a loss may force the new firm out of business. The incumbent monopoly may have significant savings to finance a price war, whilst the new firm is more vulnerable due to financing cost of entering the market. While predatory pricing laws prevent firms from charging prices that are too low, other violations of antitrust law occur when prices are too high. Collusive pricing occurs when companies in an industry conspire in their pricing and production decisions to achieve price above the competitive price and to restrain trade. Price discrimination is a selling strategy that charges customers different price for the same product or service based on what the seller thinks they can get the customer to agree to. In pure price discrimination, the seller charges each customer maximum price they will pay. Peak load pricing is a pricing strategy in which higher price is charged for the same product or service when demand approaches the physical limit of the capacity to produce that product or service. This is because when demand is high and production capacity is limited, customers are more willing to pay higher price to obtain the product or service. Conversely, companies lower price when they have excess capacity to stimulate demand and utilize their capacity. Various industries such as telecommunications, car rentals, and electric utilities employ peak load pricing. When a product is sold in different countries, various economic and regulatory factors can impact pricing decisions. Take for instance software or electronic products that are manufactured in one country and sold globally. The price charged for the same product can vary greatly in each country due to differences in purchasing power of consumers, which is a form of price discrimination. Moreover, government regulations can restrict the price that overseas companies can charge, such as in the case of certain life-saving medications. Today we talk about how managers evaluate demand at different prices and manage costs across the value chain and over a product life cycle to achieve profitability. In our presentation, we conveyed the details related to the subject and tried to answer certain questions. We hope it has helped you to understand some of points related to topic and become more interested. Thank you for listening us.